Everyone. My name is Chrysostom. I am the engagement specialist here for Capital One, which means I get a chance to work with great nonprofit partners, and I teach financial literacy courses. So as Isabel said, today we're going to talk about a couple real critical topics, and I'm glad to hear the whole series because it sounds like you guys are going to build up to wealth building. And really what we're talking about today, credit and savings are, if you can think about that as being the foundation for wealth building. I know the exciting stuff of stocks and bonds and Bitcoins and mutual funds, all that is what is kind of the sexy, jazzy stuff. But a lot of times people aren't able to accrue those things or develop those things because they don't do the basic foundation laying, which is having strong credit and also savings and budgeting. So I'm going to share my screen. Please feel free to ask any questions that you want. As I go along, you can put them in the chat. You can raise your hand. Absolutely, just stop me. I don't mind pausing if you have a question. So we're going to start talking about credit first because credit is very critical. I'm going to skip through a lot of the preliminary stuff here because I want to touch on this and budgeting and savings. But I want to talk about, and this is where this is going to be very interactive. As Isabel knows, I love for it to be interactive. One of the things that most people think when they think about credit is, of course, borrowing money. And it's true that credit is critical in assisting you to borrow money, but there are many other ways that credit impacts your life. So having poor credit can challenge you not only with regard to borrowing money, but with regard to renting an apartment. Many landlords pull credit. Okay. And there are a number of other ways that credit impacts you. Can anybody share with me who else beside a lender and a landlord? Okay, we know if you're buying a house, but a landlord pulls credit. Can anybody share who else might pull your credit? Do you know offhand? What other groups beside lenders pull your credit? Where else can your credit be used in a way that doesn't involve borrowing money? I'm going to throw that out there first and see what answers I get back. Who else pulls credit sometimes?
I'm not sure if this is a correct answer, but maybe your possible employer.
Excellent. No, you're totally correct. A lot of jobs pull credit. In fact, the federal government, when people are going for higher security clearances, Tay, why do you think an employer would pull credit? Just out of curiosity, why would an employer, or say the government, which is your employer, would pull your credit, especially if you're going for a higher clearance? Why do you think that might be
done? Because I think credit is something you build, throughout your lifetime, and I think it kind of reflects your risk tolerance, your money making management skills, as well as, I guess, trustworthy maybe.
Excellent. So great point. So your decision making, they're looking and saying, well, if this person doesn't manage their money well, what about this also? Excellent point, Tay. Exactly correct. What about this also? What if I'm entrusting you and you may have the opportunity to manage or handle thousands of dollars, tens of thousands of dollars? What might happen if you're normally an honest person, but you're in financial trouble? What might you be tempted to do that you wouldn't ordinarily do if you're in a really serious financial bind? You might make a decision that you wouldn't normally do to take money, or let's look at getting a clearance. What if someone knows that you have top secret information and you're in a financial bind? What might you do? So that's why employers look at credit. You're totally correct. They look at it as part of your decision making. Let me share with you some other folks that pull credit as well. Utilities pull credit. Cell phone companies pull credit. And insurance companies use credit. They actually factor credit in when they go to calculate your policy rate. So credit plays a big role. So that's why it can impact your ability to do what? To build wealth. So let's talk about what a credit score is, because a lot of people have a general knowledge. It's a number between 300 and 850 that summarizes how likely lenders think you are to repay credit. So generally a good credit score is one in the 700s. So anything 720, 740, 780, we generally consider a good credit score. And so that means that to a lender, you're a low risk, so you're more likely to get approved, and you're also in a situation where you're going to get a lower interest rate. See, you want a lower interest rate because the less you pay in interest, the more you keep in your pocket, the more you have to save and to invest. Okay. So I'm going to skip over this part here, asking you if you've seen your credit, but let's talk about how you can get copies of your credit. You can go to any one of the 3 credit bureaus. So we're talking about Equifax, Experian, TransUnion. I like to use the apps, whether CreditWise or Credit Karma, because those give you information about what's happening on your credit. They have push notifications. They'll push out a notification to you anytime something changes on your credit. Because one of the things that you need to be aware of, and especially as you go into the work world and you go on to college and different things, identity theft is a really big problem. And so you want to be aware of what's happening on your credit at all times. So one of the ways you can protect yourself is knowing whenever something happens on your credit report, okay, so that you could cut it off before it gets bigger. So that's why I like the apps, because you don't have to go out and ask to see a copy of your credit. They'll notify you if anything changes on your credit report. So let's take a look, and this is a really important topic here, because many of you may be buying your first car while in school or right out of school. And credit impacts a lot of decisions, but particularly buying a car. And I'll show you why. And then usually a vehicle is the biggest asset that people who don't own a home have, especially when they're young. I bought my first car right out of school, and I really didn't have any credit. Fortunately, they had a program for first time, recent graduates from college. So I got a decent rate on my first car, which is a red Chevy Nova. Still remember that. So Ms. Garcia and Mr. Jones both want to buy the same car. They both decide they're going to get a used car. They want to only borrow $10,000 for 3 years. Okay, so same dollar amount, same number of years. But after 3 years, Mr. Jones has paid almost $3,000 more than Ms. Garcia. Why? Well, Mr. Jones has a low credit score of 420. And so he has to deal with a 20% interest rate. He can only really get approved by a finance company. He can't deal with a bank or a credit union. They're not going to work with someone with a 420 credit score. He'll be declined. But now Ms. Garcia has a 720 credit score. So she's able to get pre-qualified at her bank, her credit union, and she gets a low 3.5% interest rate. So at the end of the 3 years, Mr. Jones has paid $13,378. Remember, he borrowed $10,000. That's called your principal amount. But he has to pay an additional $3,378 in interest. Ms. Garcia, on the other hand, borrowed the same $10,000, but she only pays $548 in interest, $2,830 less. That's $2,830 that she has to do a number of other things, whether build her savings, whether save for a down payment. That's money that she doesn't have to pay out in interest, that now she can put to work for her, as opposed to paying it as interest on a vehicle. Okay. Wendy says that's a big difference in interest. Yes, it is. And imagine that if Mr. Jones doesn't raise his score and he buys 5, 6 cars, 7 cars over the course of his lifetime, he's going to pay tens of thousands of dollars in interest over the course of his lifetime in vehicle interest, just for having that. And with a 420 score, there's no way that he can buy a house. There's no mortgage company that's going to approve you with that. So he can't purchase a home, which is the number one thing that builds wealth. The biggest asset that most people have is their home. So that 420 credit score is going to limit him in so many ways. And remember, I already told you that insurance companies use your credit. So he's going to pay more for his policy because of his credit score, possibly also than Ms. Garcia will, again, because of his credit score. So you can begin to see how his poor credit score begins to lock him out of opportunities to acquire the things that build wealth. Okay. I'm just going to give you a little bit of hint into what you're going to possibly deal with, some of the things when you're wealth building. I'm so excited. In fact, I'd love to sit in on that class as well. But one of the things you need to be aware of is that really the primary ways that you build wealth in this country are real estate, home ownership, which is part of real estate, stocks, bonds, and mutual funds, okay, and entrepreneurship. Owning a small business. Those are the 3 primary ways, separate from inheritance, which you can't control, that you build wealth in this country. And so if your credit keeps you from able to buy a home or start a small business or get a loan to expand your small business, it's impacting your ability to build wealth. Okay. And my definition of wealth is wealth works for you, whereas you work for income. It's assets that grow in value without you having to work for them. You may have worked to buy them and bought them, but they then grow and appreciate in value and can generate income for you versus items that depreciate like a vehicle, like clothes and so forth. So not being able to acquire those assets will hinder your ability to build wealth, both for yourself and generationally, okay? So the cost of borrowing money is driven by two primary factors, the interest rate and the time to pay off the debt. So the longer you stretch the debt out or the higher the interest rate, the more it costs you to borrow that money. But if you have a high credit score, it drives down the interest rate and then it drives down the cost of you borrowing money, okay? So higher credit scores get you lower interest rates, and it can get to the point where it lowers, of course, the cost of borrowing money. Now, the meat of what I want to talk to you today is what makes up your credit score. This is all of the ingredients that make up your credit score. Remember, we said the score goes from 300 to 850. So what makes up that score? Well, the number one thing is payment history. 35% of your credit score is made of payment history. If you don't pay on time, you cannot have a good credit score. In fact, one missed payment can drop your score by 100 points. So we'll talk later about savings. That's where savings come in handy. Let's say you run into a situation where you had an emergency and you had to spend $500 or $600 out of your paycheck, out of your monthly income to cover a bill or an unexpected expense. Maybe you had to get something fixed on your car. And so you're short of money that month to pay all of your bills. Well, if you have savings, you can dip into your savings and take it from there to go ahead and pay the bills. I'll give you another example. We're right now on tax time. And this is a personal example. My wife and I owe this tax season. We have to go ahead and pay the IRS and the state some significant money, okay? Well, we don't have it in our regular paychecks to pay them, but we're gonna dip into our savings to make sure they're paid, because two people you do not want to not pay is the IRS and the state government. Okay, so I'm not going to get into, I'll talk a little bit more in savings, but one of the things that we see is good savings goes hand in hand with keeping good credit. By having money to use in an emergency out of your savings, it keeps your credit from getting damaged. And the thing you need to know is a negative item on your credit report, a bankruptcy, a charge off, significant delinquency stays on your credit report for 7 years. Okay, it takes 7 years, okay, for it to come off. So you really want to avoid having negative items go on your credit score. Okay, next up, credit utilization. Now, this is the part that most people don't know. Most people know you have to pay on time or it can mess up your credit. But what most people are not aware is that credit utilization, how much of your credit do you use? So you need to stay below, or want to stay below, 30% of the available credit on your credit card. So what does that mean? If I have $1,000 limit, I want to stay below 30% or $300 on that card. Yes, I could charge $800 or $900, but if I do that and I take several months to pay it off, one of the things that's going to happen is while that's over 30%, it's going to knock down my credit score. Credit utilization is the second biggest thing on your credit score. When I used to work with individuals helping them improve their credit, a lot of times they come to me and they'd be like, I don't know why my score dropped so dramatically. And when we pull their credit, I'd say, well, do you know what your limit is on this credit card? They say, no. And then we look and see that they have a big balance on their credit card, but it doesn't have to even be big. You could, if you have a small available credit of 500, you don't want to go above $150. And so most people are not aware. In fact, some people think when they get a credit card, they want to run it up to the max and pay it off to show that they have the ability to pay it back. That's the last thing you want to do. You want to keep it below 30% and ideally below 10%. Credit cards should really be ideally used for needs and emergencies, not wants. So in other words, if I need to get something and I don't have the cash right now, but I know I can pay it off in the next 2, 3, 4 months, that's a good use of a credit card. But using it for just something you want and that you could really do without can run you into serious problems if you continually do that, because then you'll run up significant bills. And I'm going to show you a little later how long it takes to pay off a credit card if all you make is the minimum payment, okay? And how much interest you're actually going to pay. So the two biggest things are payment history and credit utilization. So that's 65%. 15% is made up of credit history. How long or the length of time that you're in or your accounts have been open in the credit bureau, okay? How long have you been in the credit bureau? 15% of that is what that makes up 15% of your score. So that's why we tell individuals, if you have a credit card that you've had for a long time, now I'm older, I have cards that are over 20 years old. I keep them open because they have a credit history with them. And so if that gets closed out, I'm going to lose that history and it can drop my score. Not as big as the first two, but it is 15%. So it's a decent portion of your credit score. The next thing is new credit. That involves inquiries, that includes any new accounts that you've opened. The Bureau knows that you may need to open new loans or take out a loan every once in a while. But if you have a number of inquiries, but particularly if you've opened up 3 or 4 or 5 pieces of credit within the last year or two, that'll take away some points off of your score. They feel like you may be getting into too much debt. And then the last thing is what we call credit mix. That's the mix of both installment and revolving that you have on your credit bureau. What do we mean? There are only 2 types of things that are on your credit bureau. Installment, which includes things like car loans, student loans, mortgages. Those are things that have a fixed rate generally and fixed payment. So it's 36 months at 6%. Then you have revolving. Those are things like credit cards, home equity lines, overdraft protection. Revolving just means as you pay it down, it's available for you to draw again. So if I have a $1,000 limit on my credit card, I put $200 on there, I stay below the 30%. If I pay it down back to 0, I have all $1,000 available again. With an installment loan, when you pay it off or pay it down, you have to borrow again. You have to apply again. Installment loans don't revolve. You can't have those funds available again. It's loaned to you once, you pay it off. If you want more money, you have to reapply. Okay, so the credit bureau likes to see you have a mix of both. So in my case, I have a car loan, I have a mortgage, and I have a couple credit cards. So if all of those are reporting, it'll say, well, there's a good mix of both. Some people may only have a credit card, and therefore it's going to say no installment reported, and that's fine. You don't want to run out and borrow money just to borrow it, to have it report on your credit bureau, but it likes to see that there's a mix of both being reported on the credit bureau. So what are the 2 most important, well, really 3 most important factors in your credit score? Well, it's paying consistently and on time. We said that's 35%. Staying under 30% of your credit utilization, that's 30%. And keeping your oldest accounts active. This is 80% of your credit score, okay? Now, I'll mention this also to you. As young adults, sometimes what parents will do, especially if you're not yet able to get your own credit, some parents will go ahead and make children authorized users on their credit card, and therefore their credit will then, in a sense, become yours. As they build credit and use their cards, then that's one way in which you can begin to establish credit even before you're able to establish credit on your own. Again, not a lot of parents do it, but some do, to give children a head start and start establishing good credit for them. So let's talk about how debt can be bad or good, depending on the size of the debt and how you use it. So debt can be bad if it's attached to an expensive high interest rate, and it's going to take you a long time to pay it off. But debt can help strengthen your credit if it's short in its duration and you pay it off quickly. So let me show you what happens now with 3 individuals, each of whom owes the same amount of money. They have the same interest rate, but they approach paying off the debt in 3 different ways. So you've got Mr. Lewis, Ms. Davis, and Ms. Clark. Mr. Lewis, all 3 of them owe $2,500 on a credit card that has an 18% interest rate. But Mr. Lewis pays only the minimum payment each and every month. As a result, the $2,500, which is again the principal balance, he has to pay that back. It's going to take him 19 years to pay that back, and he's going to pay almost $5,000 in interest. Almost $5,000 in interest over the course of 2 decades to pay that back. Now, Ms. Davis pays a little more than the minimum. She pays $35, but it's still going to take her 10 years and $2,356 in interest. So she has to pay back the $2,500, but at the end of 10 years, she'll have paid over $4,800. Ms. Clark takes a different approach. She pays $125, so she puts an extra $100 on top of the minimum payment. And so as a result, she only pays $444 in interest, and it only takes her 2 years to pay it off. And the main reason is that when you make a minimum payment on a high interest rate like 18%, most of that payment is going towards interest and very little towards principal. But when you make an extra payment, like $100 on top of the minimum, this extra $100 goes directly onto the principal balance, reducing the amount that's being charged 18% or 18% each year. And so in 2 years, she pays off the $2,500 and she pays a relatively small amount of interest compared to Ms. Davis and Mr. Lewis. I'm going to pause here. Any questions so far? I've hit you with a lot of information on credit, credit scores, how credit can impact, and the danger of making only the minimum payment on a credit card or high interest loan. It works for any loan, and particularly high interest loans and credit cards. But are there any questions before I continue? Any questions? All right, I'm going to jump into the next slide here. Skipping over this as far as what surprised you. Let's talk about if I'm in a situation where I'm trying to establish credit. How do I go about establishing credit? This is going to be true for many of you, because as a young person, you may not have established any credit yet. In fact, you probably haven't. So a lot of times it's very difficult sometimes to establish credit if you don't have any. Sometimes lenders will decline you, not because you have poor credit, but you've not established any. And so the standard question is, how can I establish credit if nobody will approve me? So let's talk about ways that you can go ahead and strategies for building credit. So you can start building credit by, if you aren't able to get a loan or a credit card for something you need, a lot of times you can get what's called a secured card. That's where you put up a small amount of money, okay? And the bank gives you a credit card with that as collateral. They'll hold on to that money in a savings account, and now it acts as collateral. Collateral is something that a lender can take if you don't pay back the loan. So if you're talking about a car loan, the car is collateral. If you're talking about a mortgage, the house is the collateral. So in a secured card, that amount of money, let's say it's $300 that you give to the bank, that acts as collateral. If you charge $200 on your card and you don't pay it back, not only will your credit get damaged, but they're going to take that $200 back from your savings if you don't pay it back. Okay, so that's one way that many people can establish credit. Secured cards are relatively new. 15, 20 years ago, they weren't secured cards, and people who had trouble establishing credit were very frustrated. So lenders came up with the idea, you know what, if we have someone give a small amount as some collateral, we can go ahead and make the loan because they know there's not much risk to us. If you don't pay it back, we now have your savings that we can use if you don't pay it back. But it's a great way for people to build credit and for those who've damaged their credit to reestablish it. Now, there are also things called credit builder loans that many nonprofits and some for-profit companies offer. And these are loans that you're approved for. They don't give you the money like a traditional loan for you to then go and spend. It is put in a savings account to act as collateral. And every month when you make that payment, now what happens is that they report it as a payment on an installment loan, and that begins to help you build credit. In fact, I have a young man who I was working with last year, February, and he had no credit. And I helped him, I gave him the plan of getting a secured card first. Well, he actually got a credit builder loan first. And then after he had that loan for 3 months, then he got a secured card. He had no credit. And by November, we started in February, by November, he had a 705 credit score. So if you have no credit but you have a job, you don't want to apply for credit till you have steady income, then you can go ahead and begin using those ways if it's very difficult. Like I said, I was fortunate coming out of school. General Motors had a program for recent high school graduates, so I was able to get a car. But a lot of people struggle to get credit in the very beginning when they first try to establish it. And these are two ways that you can establish credit even if you have none. And as it says here in the right corner, over 25 million Americans, it's probably well over 35 million Americans since this has been written, have no credit. They have no credit score out there. So it's not an unusual thing, but it is good to start building credit and start building strong credit when you're young, okay? So one of the other things I want to reemphasize is always pay on time. If you have to set up auto payments, auto debits, do that, but don't miss a payment if you can avoid it. It can drop your score as much as 100 points. I've seen people who've worked a long time to have a strong credit score in the 700s. And because they've run into some financial difficulty or they've missed a payment, seen their score plunge into the 600s, okay? And so you want to avoid making missing a payment. I always tell people, if you're in a difficult situation financially and you cannot pay a creditor, reach out to them and let them know the situation. Most times they will work with you, maybe give you a forbearance, stick that payment at the back end, but don't miss a payment and not call the creditor and try to make arrangements before they damage your credit. Because one missed payment can drop your score 100 points. Stay under 30% the credit limit. Like we said, whatever the limit is, try to stay to 10 to 30% or under of that amount. Use your credit card only for needs, not for wants. And manage your accounts. Don't borrow or take out too many credit cards. You may get a lot of offers in the mail. A lot of people, once you are in college or start working and start to establish your credit, are going to send you and bombard you with offers to borrow money. Be very careful. Again, make sure you borrow only for things that you need and you know that you are making more than enough, that even if your income dropped, that you could pay off those loans, okay? Because when you borrow too much and you put yourself in a lot of debt, it can be a big problem if you run into a financial hiccup, okay? So I want to skip over all of this and get to the very end, which is always visualize, okay, what it will look like when you reach your destination. But in this case, we're talking about credit, but we're really talking about using credit to acquire the things that are going to benefit you and your family. So having a good credit score, 720, 740, having the ability to not only buy a car so you can get back and forth to work, or being able to start your own business for those of you who have entrepreneurial dreams, being able to purchase a home when you have the income and the savings and so forth. These are the things that credit unlocks. But without good credit, you're cut off from these things, cut off from ways to build wealth and do many of the things that you really hope and dream to do. So I'm going to stop at this point. And any questions before I jump into savings, any questions about credit or anything that I've shared with you with regard to how credit impacts your ability to acquire things and ultimately build wealth? Any questions?
Sean, I have a quick question.
Sure.
So you mentioned if you miss a payment, it can drop around 100 points or up to 100 points.
Mm-hmm.
Would there be a difference in terms of, the impact, like based on the amount of the payment that one might have missed?
Great question, Tay. I've never had that question before. No, it doesn't. They don't look at the amount. A 30-day delinquency is a 30-day delinquency. Very good question. So if I miss a payment of $50 on my credit card, it's going to hit me the same as if I miss a $400 payment on my car note. Very good question. They just look at it as a delinquency. It doesn't matter. But that's a great question, Tay. I've never had that question, but it's an excellent, excellent question. No, the amount doesn't matter. It's the fact that it's delinquent. And that's what's kind of scary, Tay. So let's say somebody can't make the minimum payment of $50 on a credit card. It'll hit them just as hard as if they miss a $1,200 or $2,000 payment on their car, on their mortgage.
Right. Okay. Thank you. Great
question. In fact, I'm going to use that, Tay. I'll give you credit, but I'm going to bring that up in my future workshops because I've never had that question asked, but it's an outstanding question. So I'm going to throw that in there. I'll give you credit though.
Thank you. Building it slowly.
Absolutely. Any other questions? Any other questions before we jump into savings?
Yeah, so Sean, I have a question about building credit. So you mentioned earlier that like sometimes your credit could be affected, like if your parents like used a credit card in your name, could you do like the opposite to help your credit?
When you say using, well, what a parent would do or can do, some parents, what they would do is they would just, in other words, make you an authorized user on their credit card. Okay. And so by doing that and adding you as an authorized user, then whatever their credit is doing as they pay back on time, now it's reported on your credit bureau as well as theirs. Now, let me understand your question. Your question is the opposite. When you say
no, that's what I meant. That was it. I'm sorry.
Okay. Yeah. So as they use and pay back their credit, now say that happened to you, Juan, it would be reported on your credit bureau, paid on time. So now, Juan, when you finish college, maybe you've got a master's or you look like somebody's going to have 2 masters and a PhD, Juan. So you do all of that. Now you're like, wow, I'm coming out of college, but man, I've never borrowed anywhere. We say, wait a minute, my parents for the last 8-10 years, I've had authorized users. So when you go to apply for something, they're going to say, well, Juan, you have a 750 credit score. okay? Even though you've never applied for anything yourself. You see what I'm saying? It's because their credit. Now, I'm going to show you one other flip side though, Juan, and this is why it's good to have it cut off after a while. Not that your parents would do this, it works in the reverse as well.
Yeah, that's what I was thinking.
Missed payments, guess what it's going to do to your credit?
It affects mine as well. Yeah.
Exactly. You're tied to them. So a lot of times what I recommend if a parent's doing that, after a while, the child should say, take me off as an authorized user. I've got my credit established. I'm doing good. You don't want to continue to have your credit tied to somebody else. Okay. Great question, man. Excellent questions. All right.
I do have a question as well.
Okay, go ahead. Who's that? You didn't pop up. Who's that? Who has the
This is Brittany.
Hey, Brittany.
Hey, I wanted to know, what is the difference between a FICO score and a credit score?
Excellent. Credit score is the generic name for all credit scores. FICO stands for Fair Isaacson Company. They're the ones who 50, 60 years ago came up with the credit scoring model. So they're still the big kahuna in the credit scoring. The credit agencies, Equifax, Experian, and TransUnion, okay, may use the FICO score, but they have their own score called the Vantage score because they kind of compete with FICO. So when we say credit score, we're talking about the whole world of credit scores, whether it's your Vantage score or your FICO score. FICO is the more commonly used, and that's because Fair Isaacson Company came up with it and have built a business off of the credit score. So FICO is a type of credit score. You also have Vantage, which is not as popular, but it's what the three credit bureaus, they've created their own competing, but they all use the same principle. So when we say credit score, we're talking about whether it's your Vantage or FICO, we're talking about one of those scores that measures your credit. But very good question. It's like I planted that question, Brittany. That was excellent. Excellent.
Yes, because I wanted that for reference. But also FICO score is like, my FICO score is extremely high. And then it may be like my Vantage score, maybe about 20 points lower than what my actual FICO score is.
Because they're even though you have the general rules are the same, Brittany, they tweak it a little bit. Like, for example, you may have heard of Experian Boost. Experian is the only one of the three that is now offering to include non-traditional credit to boost your score. So you can have your utilities. So each of them tweaks it a little bit, but the basics are the same of what the FICO Fair Isaacson Company came up with 60 years ago. But they'll tweak it a little bit. It could also be that on the FICO, it has something reported on there that's not on your Vantage. But generally, it's just because the other thing too is there are different iterations. They're always tweaking it. In fact, you just brought up something very good. This doesn't impact you guys, but it could impact some of your family members or people who have had their credit for a while. This summer, all three major credit bureaus are going to remove all paid hospital debt from credit scores, which is going to be huge for a large number of people. One of the biggest things that impacts people's credit score is delinquent hospitalization or medical debt. And this summer, they're going to be removing all of it. If it's been paid and it's been reported, they're going to remove all of that. And then they're making another rule that they're going to wait 2 years before they report any new debt. So that's to help a lot of people who are good payers, but they ran into problems and they had some medical debt, and that's been damaged. That just came out. I saw it in the Wall Street Journal about 2 weeks ago, week and a half, 2 weeks ago. So that's huge. They're going to remove all of that from millions and actually probably tens of millions of credit bureau reports starting this summer. And that's all three major credit bureaus. So.
Now we just need student loans.
Absolutely. All right, so let me jump into the next one. We're going to talk about savings. So we talked about credit. Now, I will tell you that savings is not a sexy subject. People want to talk about Bitcoin. They want to talk about Robinhood. They want to talk about stocks. All of that's great. But savings is the quiet thing that helps you make sure that you don't have to dip into your investments. You don't have to sell your real estate. You don't have to sell your Bitcoin. Whatever it is that you're saving for long term, you don't have to touch it because you run into a situation. And like I said, I'm not making this up for this situation. My wife and I, we did our taxes and we were kind of surprised because of some situations. We had a significant tax bill. And like I said, you don't want to owe the IRS. You don't want to not be able to pay your taxes. There's penalties and interest that can accrue. And so we had to simply say, you know what? Didn't anticipate this. but we're going to have to dip into our savings to pay both the state and the IRS. Okay. Now, I don't like it. I'm feeling a little, but I'm glad that I have it to pay it. And that's why savings is important. We can't always plan for everything that's going to happen. But when you have emergency savings, then it can help in those difficult times. Savings can prevent a problem from becoming a crisis. Most US households faced at least one major, and coming through the pandemic, multiple unexpected expenses in the last year. And savings can keep you safe from what we call debt spirals. That's where one unpaid debt, like we just talked about, it could be a medical debt, causes your credit score to drop, or it causes you, because you had to pay that debt, you couldn't pay your rent, or you couldn't pay your car note. Now you're possibly faced with repossession or foreclosure. That's what we mean by debt spirals, things spiraling out of control. Someone can't get their car fixed, so they can't go to work, or they can't get the hours that they need to pay their other bills. And so now they run into all kinds of problems. So even a small amount of savings can help you avoid financial hardship. I encourage you all at your very young age is to begin savings. One of the things that I'm so excited about is my daughter, even as she was growing up, she's 26 now, she'll be 27, that she's really developed a strong savings habit in both her 401k, her retirement at her job, and even putting aside money. She got stimulus money each of the last couple rounds that were done, and she put it all in her savings account. So I'm very proud of that. Now my son's 21, the saving stuff, he hasn't gotten around to that yet, but he'll get there. But savings is very critical. Okay, and having a savings plan, which is what we're going to talk about, is very critical to you building wealth and being able to do some of the other things that the good credit will allow you to do. So there are three different types of savings that we talk about. There's the rainy day savings. That's where for small unexpected expenses, and I can talk to that. Just last week, I saw the air kept going down in my wife's truck. Sure enough, there was a nail in there. Had to take it to the car dealer, said they can't, to the auto repair, they can't fix it, they can't repair it, the nail, I have to get a new tire. At the end of the day, $270 I was not planning on spending. That's what rainy day savings is for. It's for those unexpected expenses. You see the car being towed there. It's for things that you didn't plan on. Your car doesn't turn over in the morning, okay? All of a sudden, something happens and you have to go out and spend an extra $200 that you weren't anticipating. Okay, that's what rainy day savings is for. Okay, that happened to you Sunday night. Ooh, I know that's it's no fun when your car doesn't work, or you get up to start for work and you go to click it and it doesn't turn over. I've had that happen to me.
Yeah, it was my first day back and I couldn't come in.
Yeah, that is no fun. It's no fun, and now you have to either get it towed or you got to go get a battery. That is absolutely no fun. But again, if you have the money, or denting your car at your work garage.
Oh man.
I'll just assume, Wendy, that's something that somebody you know did. You don't have any personal experience
on
with
the
that.
first day back to the office in
Ouch.
2 years.
Ow.
Yes.
Yeah,
Yes,
that's called rainy day.
rainy
now-
day.
Exactly. Emergency savings are bigger than rainy day. That's for things that are much larger, that are unplanned. Most financial advisors recommend having 3 to 6 months worth of expenses in your emergency savings. The reason they recommend that is that should be enough cushion that if you lost your job, you'd have enough money to pay your bills until you find another job before your savings run out and you can't pay your bills. And now you're in a financial bind. Your credit is damaged, or now you're being evicted or something like that. So generally we want to build a 3 to 6 months worth of expenses. So what does that look like? Let's say between your rent, your car note, and your utilities and everyday expenses, it's $2,000 a month. Let's say you're sharing an apartment with a couple friends. Okay, so your rent's $800 and everything else. That means your goal would be to try to save about between $6,000 to $12,000. Now that sounds pretty big. It's not going to happen overnight, but about $6,000 potentially on the low end, so that if you were to lose your job, you could still pay your portion of the rent, you could still pay your car note, you could still pay your insurance, and you can do that while you're looking for another job. And it might take you 30, 60, 90, even 120 days to secure that new position. Now, targeted savings are the fun savings. That's where you have a planned expense and, like school expenses, holidays, a new house, or travel. you know, you're planning to take a trip this summer and you're saving away, or you're planning to take a trip in the fall and during the summer you're working and you put aside money. That's what targeted savings are. They're money that you put aside specifically for an event that you're looking forward to. Okay. Normally, what I generally recommend is you can combine your rainy day savings and your emergency. You don't have to have separate accounts. So I wouldn't say have 3 separate savings, but I would keep my targeted savings separate from the other 2. And here's why. When I have targeted savings, I'm excited generally about why I'm saving for it. And I don't want to have to dip into it if I, let's say, accidentally dent my car or my work garage, or I have to spend it to get a new tire. If I dip into that money and I look at it as part of my targeted savings as well as rainy day, I feel like I'm moving backwards from my goal. Maybe my goal is to save for a wedding, or I'm saving to take a class. And if I have to take money out of that one pot, I feel like, man, I was going to have the money in 2 more months. Now I've taken a step back. So I generally recommend having a targeted savings and a rainy day / emergency savings that's combined. And of course, you dip into the rainy day savings and emergency first before you touch your targeted savings, okay? Because that's what it's there for, okay? So again, you don't have to have 3 different savings accounts, okay? You can just have 2. But you want to separate them, especially when you start to build a targeted savings account. So today we're going to talk about setting a goal. You remember, if you have a plan, okay, but not a goal, okay, then you really have a wish. I like to say a plan without a goal is a wish. A goal is a specific action plan in which you say, I plan to do this for this amount, and this is how I'm going to do it. In other words, it's a SMART goal. It's specific, it's measurable, it's attainable, it's, you know, and it's time bound, okay? So a lot of times people will say something like, I want to start my own business. That's not a real SMART goal. That's a general goal. A SMART goal says, I plan to save $300 every month for the next 2 years, which will give me enough. I'll have $7,000+, which I'm then going to use to go ahead and acquire the business that I want to do. And then you can lay out the business. That's specific and getting into the details of what you're going to do, when you're going to do it, and how you're going to do it. Studies show that if you just make a general goal without any specific plans behind it, you're less likely to achieve it. Okay. So you want to choose one simple goal, okay, that you can picture clearly. For some of you, it might be this summer. Maybe you'll start working and you say, you know what, I start school in the fall. I want to save $1,000 from when I work this summer to put aside so I have spending money this fall when I go off to college. And so you'll break the goal up. I'm going to save $200 every 2 weeks for the next 6 weeks. So I'll have $1,200 when I leave for college. Okay, that's making your goal a specific SMART goal. Then envision your success. Think about how you're going to feel when you get to that goal. That's what savings does. When you have enough for the down payment on your car, or for the security deposit on your new apartment, your first apartment, or the down payment on a house, how excited are you going to feel? You know, how are you going to feel when you're in college and you look at your savings account and it's your second week in college and your friends are all going out somewhere and you're like, great, I can go. How are you going to feel when you have the money and you don't have to pass on it and stay up in your room because everybody's going to hang out this weekend? They're going to go catch a movie, you know, or it's been stressful and the exams are going on and you just want to get a little break. How are you going to feel when you achieve that? That's what you want to think about when you set a goal. Okay. So let's look at an example here of somebody that's written up their plans and their goals. Okay. It says, I will feel better when I pay for the repairs to my car. My life will be better once I've done this because I will have less stress in the mornings about getting to work on time. If I can take my car instead of the bus, I'll have more time to eat with my kids. I will tell you as a parent, when you have children, savings becomes even more critical, okay? Because you now feel like it's not just my comfort that's riding on the savings, it's my children as well, okay? So in other words, if I don't have the money to pay for certain things, one of the biggest stresses on parents' minds is when their children need something. As parents, a lot of parents will or don't mind sacrificing themselves, but they don't want to have to tell their children no, or we can't do that. You know, that's why a lot of parents, I caution them when they start saving for college, to be very careful, because sometimes they'll agree to getting into significant debt, and the student getting into significant debt just because they don't want to say no. Parents generally like to be able to provide for their children. And so one of the things that savings does is it means that parents don't have to feel that stress if a financial situation happens and maybe their income has dropped. They can still pay their bills. They can still do the things their children need, still put food on the table. So savings is very critical. And so that's one of the reasons that a lot of people, when they make a plan, I tell them, think about how you're going to feel when you hit that goal, and you know that you don't have to worry about something disrupting what you want to do for your children. Okay. So what's the best way to save? Well, if you get a regular paycheck or you're getting money on a regular basis, the best time to save is when it first comes in. Don't do a budget and say, after I pay all these bills, then I'll see what's left over. Pay yourself first. Take your savings off at the top. Make a goal of how much you're going to save and let it come off in the beginning. Have your job send it to a separate savings account. Don't mix it up with your checking money. Most jobs will do 2 different direct deposits, one into a savings and one into a checking. So the best way is to say, look, I want a payroll deposit to go $100 every paycheck or $50 every paycheck into my savings. The rest goes into my checking and I live off of that. That's the best way to save. If you wait until the end of the month, or you wait until you've paid all your bills to then say whatever's left over, oftentimes there's nothing left over to save. So you make savings a priority. Pay yourself first, okay? So how much can you save? It differs for different people, but one of the things we want you to do is get excited about how much you can save over the course of a year or 2 years. A lot of times people will be very, they won't be excited about the fact that they can only save $20 a week. They'll say, that's really nothing. What's $20 a week going to do? Well, if you think about it, $20 every week over the course of 1 year is $1,000. If you do that for 2 years, it's $2,000. If you can save $50 every week, now we're talking about $2,500, over $2,500 in the course of a year. And so now all of a sudden your eyes start to open up that, wow, if I'm just consistent with my savings, it can grow pretty significantly in the course of a year or 2 years. Now, one of the things I want you to understand is you want to set yourself up for success. So don't make the goal too high. If $5 or $10 is reasonable and you can do that easily, start there. You can always increase the savings amount that you plan to save or the amount that you want to save in the future. But if you set the goal too high and right off the bat you can't hit it, you can discourage yourself and give up right at the very beginning. So one of the things you can do too to help increase your savings is think about ways to save money. Okay, can you shop around for frequent purchases? Find gas, as expensive as gas is. Find cheaper gas. Avoid fees. Unsubscribe. My son, we'll find he's subscribed. He's got Spotify. He's got all these other things. We're like, how much of that are you using? Make sure you're using it. And if you're not, cut it out. Cut that subscription out. Save money. Identify free trials. Yes. Oh, Isabel, have you gotten caught with those? I'm bad with that. Free
Yes, I
trials,
forget to
and
cancel.
Huh?
I forget to cancel. They're like the first month free, the first 3 months free. And then they charge your credit card and you're like, what?
And then you're like, oh man, I forgot that. Yes, be careful, absolutely, of those free trials. The reason they do that is they know that most people forget. Put something on your calendar, cancel day 31 before they charge me. Absolutely. Make sure to remember that, those free trials, the scams, absolutely. Also, use coupons, coupon apps. Go and do free activities, okay? Reduce your cable subscription, bring extra lunch, cut back on your, try to find a cheaper cell phone plan. Student discounts, absolutely. Any way that you can save a nickel is money that you can go ahead and put aside in your savings, okay? I want to get to the last part and then I'll open up for final questions. Things don't always go according to plan. Understand that. That's not just true about money, that's true about life. But what you have to do is say, I have a plan B. Very few people have gone, in fact, no one I know has ever gone through life with things going smoothly. There's always a hiccup. There's always unintended expenses, things that you didn't plan for. But if you have a backup plan and you already know if something happens, I have a fallback, you're more likely to be successful than individuals who don't have a backup plan and get discouraged easily. Okay, so always have a backup plan. Okay, all right. Now, what happens when you use the backup plan and things happen? Remember, if you have to go to the backup plan, remember, a setback is not a failure. The fact that you had to go to plan B and things didn't work out initially is not a failure. Okay. If, say, you're saving for a goal and you had to use some of your savings before you got to the goal, don't get discouraged. Get back on track and begin saving next month. Okay. Or for 2 months you had to do it. Don't get discouraged and give up. Remember, a setback is not a failure. It happens to everyone. You just need to continue and get back saving. So I'm going to stop at this point, stop sharing my screen, and open up for any questions. It could be about credit, it could be about savings, it could be about wealth building, anything else. I've got 5:56, so we've got 4 minutes. No questions? Did we get them all out during the credit section?
I actually have another credit question.
All right.
It's
all
actually
right.
been asked of me before, and I don't know the answer.
Mhm.
It was one of our high school students. How old, like how young can a child be to like start the process of building their credit?
Well, technically for themselves, they can't be younger than 18, because at 18, you can legally enter into a contract. So no creditor is going to allow you to sign or borrow money if you're younger than 18, because legally you can't do that. But you can start younger if a parent decides to put you as an authorized user. So you could be 10 years old and a parent can make you an authorized user. So there's no age limit, because you're just piggybacking on your parents' credit as far as that. Now, no one's going to do it with a 3 or 4-year-old, but you can do it with a child younger than 18, because what you're just doing is saying, I want to make my child X an authorized user. But for yourself, you can't enter into a legal contract till you're 18. So
Gotcha.
that's the earliest you can get started doing it yourself.
But your parents can help you as young as 10 years old.
Because, yeah, they could add you as an authorized user at a younger age. Yep. And so it sounds that, but some parents look at it as a way to get their kids in the credit bureau. So by the time they're 18 or 20, they've been in the bureau 10 years already.
By the time they try to buy a car, they're better off.
They've got well-established credit. Yes.
Things no one tells you. What are your thoughts around like store credit cards versus like college credit cards? All the
Don't
like
get them. I don't like store cards. They're very high interest rates. I'd rather you get a good Visa or MasterCard with 8 or 9%, assuming your credit's good. Because even if your credit's good, you're going to pay 23% for a store card. They aren't going to be cheaper, you know. And those that they can suck you in. I don't like them. Now, if you're disciplined, I will tell you, Isabel, I'm going to be totally transparent. I have done it when I've gone and they're offering me 40% off that one day. But here's what I do. I go in, they gave me, I know I'm going to spend $300-400 because I've got to get some stuff. I need some stuff, and I was going to pay cash or use my debit card. If they've got a 40% off or 25% off and additional, and I calculate, I'm like, well, I can save $100 on $300 I was going to spend. Here's what I did. Literally, I mean this, I bought it. I applied for the card. I got approved. I used it that day. They rang it up at the cash register and said, okay, we're taking this off. And I said, we're going to apply this. I said, by the way, can I make the payment on that card right now? They said, yeah. So I paid it right there. So there was no chance I would let it continue.
strategy.
I made the payment right there and then. Okay, because what happens is they know that when the bill comes, you're tempted to do what? Make the minimum payment. And now you're paying 23% on that balance. And then next month, oh, I'll get to it next month. So you make the minimum payment. Remember, we showed you what happens when you make minimum payments. It can cost you a lot in interest, but that's a great question. I'm not in favor of them. I'd much rather you just get a regular Visa or MasterCard from your bank or credit union and use that. And the other reason I don't like store cards, it encourages impulsive shopping. Credit companies know that you spend 20 to 30% more if you put it on a card versus cash. So you would never do this, Isabel, but you're going in and you said, I really am just going to get a blouse and a skirt. That's all I need. And they offer you a credit card and they give you a $1,500 limit because you've got great credit. Guess what you're more likely to do? Not walk out of there with just the blouse and the skirt. You're more likely to do what? See a pair of shoes, see a couple other things that you like. Huh?
They just offered me money, so now I feel like I got money.
It does not feel the same in your mind spending a credit card versus handing cash. It's two different emotions. Your mind doesn't process it the same way. When they swipe that card, you don't feel the pain of handing over money that you've had to work hard for. It's two different, the connection is not there. And that's why a lot of people get themselves into trouble with credit card debt.
Mhm.
Hey, Sean, do
Yes.
you still have that store credit card? And
No, I
could you
actually
also-
closed it. I closed it out because I didn't really want it, and I knew I wasn't going to use it anymore. Yeah.
Perfect,
So no,
perfect.
I think I closed it out. Tate, now that I'm thinking about it, did I close it? I don't use it. So I might have, I might not have. I'm being honest with you. I intended to. I may not have closed it out. So I may still have it, but I know I've thought to myself, I'm never going to use this again. And if I did need it and I went in there, they'd probably be offering me some discount, but I think I may have closed it out. And the reason, remember I told you, don't close out old cards, but that was a new card. So it didn't have any history with it. So I knew it wouldn't damage my credit. But I just knew that I only took it because they were offering me such a great deal, 40% off. It was something really ridiculous, like 40% off any purchases today if you take this card. And I was like, wow, because I knew I was going to spend a lot of money. Let me just give you a hint, Tay, I'm cheap. So when I go shopping, I'm generally buying a lot of stuff because I try to avoid shopping. So I did a quick calculation in my head. I'm like, man, I'm gonna save $100-something today if I do this. Okay. And I had planned when I went back home to make the payment as soon as I got the bill. Because let me share that with you. Good point, Tay. You just reminded me of one thing. If you put something on a credit card and you have no balance, you have zero balance going in, and you put $600 on a credit card, if you pay it off when that bill comes completely, I don't care what your interest rate is, you're not going to pay any interest. The interest only begins to accrue after that month if you leave a balance. So some people do that. My daughter included. She likes to get miles on her Capital One card. She has a miles card. So what she does is she puts everything on her card that she would normally put on her debit card. I'm not recommending this because you can get in trouble doing this if you're not disciplined. But she puts everything on the card to get the miles, okay? And she pays it off each month, so she pays no interest. I'm actually not disciplined enough to do that, but she is. She loves to travel. She's a millennial, and but she puts everything on her credit card instead of her debit card to get the points, but she pays it off every month, so she pays no interest.
Yeah, and there's some cards with great cashback offers as well. So I understand.
Absolutely, they are. But you have to be very careful, Tab. I've seen people try to execute that plan, and when they put it on there, something happens and they can't pay it off that first month. And so it rolls over. So they're going to pay interest. And then 2, 3, 4, 6 months go by and they're paying interest on it when their plan was to pay it off. So I always caution when I tell people about that, because it can work. And I've seen people make it work. I used to be a small business officer for Capital One. I had a client who did that with his business credit card. We had a 5% off and he had a pretty sizable business. And so he put everything on that business card. He had a $100,000 limit, and literally the amount of money he would get back at the end of the year on that would be significant. He'd take trips and so forth. But again, that takes an extremely disciplined person, and that can blow up on you, especially if you get in the habit of spending more than you have to pay off each month. In other words, if you start buying things that you don't have the money to pay it off each month, that can spiral out of control really fast, damage your credit, and put you in debt.
Right. Makes sense. Thank you.
You're welcome. All right. If there are no other questions, this has been
I
fantastic.
just have one thing for
Okay, go ahead,
the
Brittany.
trial scholars. I just have one thing, and I wish someone would have told me this when I was coming, because I became extremely disciplined with my credit. However, your credit score right now is like, oh my goodness, what does it mean? I don't really have a lot of credit cards. Your credit score correlates that to your GPA. Your GPA is now your credit score. So if you do understand, a certain GPA will get you a certain amount of scholarships, a certain amount of grants. It can even allow for you to be in certain programs. It can allow for you to attend certain colleges and universities, right? You get more perks when you have the higher grades, right? So it's the same thing as your credit score. You get more perks when you have good credit. So always just do good.
Excellent.
That's
Love it,
it.
Brittany. That's exactly true. The more opportunities come available to you, so I've enjoyed this. This has been fantastic. I would highly recommend attend all the sessions. This is a great opportunity. Most students don't get a chance to learn this. before they launch. So please, I highly recommend taking advantage of it. It's been fantastic. Have a great evening and look forward to the next session.
Thank you so much, Sean.
Round
Thanks,
of
Isabel.
applause.
For you, as
Thank you
always.
so much.
Thank you.
Thank
Everyone,
you.
there's a quick link in the chat. Please complete that survey on your way out as you walk out the room, close out the room. Love
Okay.
your feedback as we keep doing these. As I mentioned, we're trying to do this on an annual basis, and we have many more. And so we try to tailor these topics based on what we hear and what's most needed across all our classes. So the better feedback we can get from you all, the most help we can get is awesome. But other than that, we'll hang out here, make sure everyone has that link. If anyone else has other thoughts. Otherwise, we hope you stay warm out there wherever you are. Stay dry.
Yeah,
Thanks, you too. Bye.
awesome.